Today we'll be getting an update on the performance in Q3 across asset classes. We'll be discussing the Fed rate cut, equity valuations, and the bond market implications looking forward. Let's get into it. Welcome to Modern Wealth's third quarter market update. I'm Stephen Tuckwood, Director of Investments, and I'm joined by Neil Falconberry, CFA, Managing Director of our Reston, Virginia office. The third quarter was really interesting across risky assets, and equity markets had a very good quarter, although very choppy in the beginning. A lot going on. We're looking forward to digging deep into that. Neil, welcome to the show.
Thank you, Tuck.
What did you make of the third quarter for risky assets, public equities, credit markets, and even commodities?
What a terrific quarter. Returns were terrific across all segments of equities, even some that have been ignored so far year to date. And we finally got the bond market back. Returns are now positive year to date. What was interesting, if we just sort of set the S&P 500's return of 5.9% for the quarter as a baseline, it was interesting that the NASDAQ actually underperformed for the first quarter in a while. So we're actually seeing the market now broaden out from the Magnificent Seven, the Microsoft, the Google, the Teslas of the world, and particularly small cap stocks really had a great return, 9.3%. International stocks up 7.3%. It's a very healthy sign, I think, to see the market broaden out beyond just a handful of 7 to 10 stocks and really see gains across the board. Then I think in the bond market, one, it's just good to have positive returns, come back. Certainly the anticipation of the Fed rate cut was very helpful in the bond market. And I think still surprisingly is the performance of gold. But for now, just a fantastic quarter across equities and the bond market.
Absolutely, yeah. Feels like it's been a long time coming to get some positive returns in the bond market. That really leads into what the Fed's been doing on the interest rate side. So for this next section, we wanted to dig deep into that. There was a big decision in September. September 18th, the Federal Reserve got together and finally reduced interest rates by 50 basis points. And there was a lot of debate going into that, whether it would be 25 or 50. The move itself was expected and anticipated by the market, and the Fed certainly delivered there. So here we're just looking at that federal funds rate over time. This is going back all the way to the 1990s. And you can see those periods of time where we have those flat levels after a large rate increasing cycle, and then what typically comes after. So some really standout periods here. We have the dot-com bubble at the beginning of the 2000s. We have the great financial crisis in 2008 and the Fed's actions there. And then we stayed zero for a very long time as the economy generally recovered from that. We were off to a rate increase, but then obviously COVID happened, and we all know the Fed's moves there. So we've gone on this really parabolic move higher on the federal funds rate as the Fed was really fighting inflation, and then we've had this period of time where it's plateaued. So the big question is, what does it mean when the Fed begins a rate cutting cycle? And it can mean a variety of things, and it's really contingent on, do we ultimately have a recession over the next 12 months, or do we avoid a recession? That's really the key driver of the S&P 500's performance in the past. So here's a chart just looking at the averages. So from that point where the Fed begins its rate cutting cycle, what has been the median return of the S&P 500 over the next 12 months in blue when we avoid a recession, and then in gray when a recession happens in that time period. So it's very much a case of, is this going to lead and help us achieve a soft landing, in quotes, where we avoid a recession? Or is the Fed moving too late and things are deteriorating too much that even though they're reducing the interest rate and easing financial conditions, that it's just not enough to avoid that? Very hard to predict, obviously, and the markets are a discounting mechanism of sorts where they're always looking and trying to build this into the current price. But Neil, let me turn to you and ask, what are your opinions of the Fed's move? Was 50 appropriate? Would you have preferred to see 25? Is their timing approximately right, or would you like to see something different?
Tuck, one, I think you've really done a good job here of highlighting what I think is the most significant event here in markets. There's lots of conversation about an election that's coming up in 6 weeks, but I think you've really focused here on the issue, and that is, as the Fed raised rates and then kept rates elevated for a high enough level for a long enough period of time to have enough debt reset at high rates that then pulls discretionary income or margin away from the economy, that leads to a recession. I think we all want to celebrate a Fed rate cut. Certainly the markets did in returns in the third quarter, but the history is very mixed. I mean, if you look at the first rate cut following a Fed rate hike cycle, they're some of the most unappealing times to be owning equities. And yet there are some occasions where they're absolutely very well managed by the Fed. Rates are cut in line with where inflation is. The economy does achieve a soft landing. And I think there are many similarities. The last one we had was 1994-95. I think the Fed did a great job in that hiking cycle. I think there's many parallels to the current cycle to 94-95 that would suggest a soft landing, might be in order. But it certainly seemed to me that the Fed was correct in its position to start cutting interest rates. I think while we're still running such large deficits, I think this year we're going to run a federal deficit of about 6.5% of GDP. That's borrowing a lot of money from the future to pull into consumption today. Very difficult to have a recession when you're using deficits to that degree. But those deficits are inflationary. And I think what has worked pretty well for the last year and what financial markets have liked is that you've had a Fed with tight monetary policy, right? Raising rates, trying to slow the economy to bring inflation down. But you've had fiscal policy be very loose, running deficits that is pro-growth, pro-inflationary. And these have been somewhat at odds with each other and creating a bit of a Goldilocks scenario, right? Where growth is healthy and robust, but inflation is still coming down. I think now with the Fed cutting rates, monetary policy and fiscal policy are now rowing in the same direction. That is definitely pro-growth. It does risk inflation coming back. We now have China stimulating their economy in very significant size, as we've seen response in Chinese equities here in the last 2 weeks. Again, that also is pro-growth, pro-inflationary. I would be surprised. I think the first 50 basis point rate cut was probably appropriate to get something started. The market was pricing in near certainty of another 50 basis point cut in November. That now has been completely taken off the table, right? So now the probability, I think, is near zero that we're going to get a 50 basis point cut, probably back to 25. So I would say good start by the Fed to get the rate cut cycle started. I'd be very surprised if we continue to see additional 50 basis point cuts given the reflation that's now already back in the cycle.
Yeah, definitely. And as you mentioned, another meeting in November to come here and one in December as well to round out the year. So all focus will be on the Fed's action for the remainder of the year and into 2025. Let's turn to the equity market and everybody's favorite index, it seems, the S&P 500 here, where we're looking at valuation of the equity market. And fundamentally what that means is, what are we paying per unit of earnings for the S&P 500 in aggregate? That's what this chart's showing. So typically during periods where we're paying a lot of money for future earnings, that's not always a good setup for future returns from an investment standpoint that are as high as they might be. As you think about the equity market, Neil, in general, valuation-wise, is it overstretched? Is it where it needs to be given all the things that you'd laid out in terms of Fed's about to embark on an easing cycle and we have the running a deficit essentially stimulating from the fiscal side? Does this feel about right, or is there perhaps some concern here just given how elevated valuation is?
I think this calls for concern here. I mean, we're trading at 24 times next year's earnings, right? So this is a chart that's looking at price to next year's earnings, not trailing earnings. And if you go back in time, it's pretty rare that you trade above 24 times earnings. On this chart here, we have only two prior occurrences, post-COVID stimulus, where a lot of cash went into the equity market, and then the dot-com period, where valuations ultimately reached up to beyond 30 times forward earnings. So valuations are clearly high. The market's been cheaper about 95% of the time, so you're in pretty rare air. But again, I think, Tuck, to your point earlier, the issue is the Fed cutting rates because they're concerned that higher rates have in fact slowed the economy and a recession is imminent? Or is the Fed cutting rates now because inflation has come down and they're just bringing interest rates back into line with inflation? So there are parallels to that 94, 95 soft landing that we achieved. At that time, the S&P was trading for about 30 times earnings. The market went sideways for that first year once the Fed had finished rate hikes and began cutting interest rates. But earnings then grew 37% and 33% in the subsequent 2 years, and that brought valuations back. So, Tuck, to your point, if this is a scenario where the Fed is cutting rates because we are normalizing interest rates for now where lower inflation is, then it's very possible that high valuations will grow into them. Right, that earnings will grow significantly over the next couple of years, and that this valuation metric is not something to be afraid of. Right, it might mean the market stalls a bit while earnings catch up, but I don't think this is necessarily a bad thing. So if we look ahead to where earnings are for next year, on this chart we're showing on the black line earnings estimates for 2024. The blue line we're showing earnings estimates for the S&P 500 for 2025. And a couple observations here. The first is for 2024, we're now at new lows to finish this year in terms of earnings estimates. This has not been a great year for earnings in spite of the market doing so well, which is why valuations are so high. And earnings estimates have really been flat now for about 15, 16 months. You compare that to the blue line, and there's a lot of optimism now priced into equities. The market is now pricing in about 15% earnings growth in 2025. That is the market giving some credence to that soft landing scenario where the Fed has slowed the economy, inflation's under control, we're not going to have a recession, and we're kind of off to the races now. So I would say the equity market is pricing in very healthy economic growth, healthy earnings, about 15% earnings growth, as in fact pricing in now this soft landing scenario versus the alternative, which is Fed cuts rates out of panic that high rates are going to lead to a recession.
Absolutely. And the counterbalance here is often on the fixed income side. So public equities are typically a large proportion of a client's portfolio, an investor's portfolio that's doing the growth, the driving of growth over long term. And we're certainly big believers in the ability of the public equity market to provide growth over inflation and to grow people's wealth. There's volatility with any risky asset such as public equities, and that's why we often approach things with a more balanced portfolio. And the opposite side then of the ledger is the fixed income market, and treasury bonds, corporate bonds, and the like as a counterbalance to periods of time where equities might be in a decline. So as we think about the US Treasury yields, and so this is showing the curve, the US Treasury curve out by maturity schedule of the bonds, so anywhere from a 1-month bond all the way to lending to the federal government for 30 years. The blue line is at the end of this quarter, and the orange line was at the quarter prior, so the end of Q2. So you can just see there's been a fundamental shift in the overall yield curve. Rates have moved lower. These actually happened in anticipation of the Fed rate cut on September 18th, as markets tend to do. They tend to predict future moves. So we certainly saw that across the yield curve. And what that means is if you were invested in bonds going into Q3, you likely had a positive return, as we showed in the beginning of the presentation here. But now we're at the blue line. So rates are lower from where they were. Still a long way from some of the really low rates that we saw when the Fed's funds rate was zero. But this is the landscape. So you can see from a 2-year bond to a 10-year bond, there's not much additional yield that you earn currently by going out from 2 years to 10 years. It's quite a flat belly of the curve, as we'd say. So that has some implications for how we might want to think about investing in the bond market at this point. But Neil, as you're building portfolios, where on the curve are you allocating new capital as a counterbalance to more risky assets?
I think still that middle part of the curve there that you were just highlighting. So the 2-year to 5-year part of the curve really looks particularly interesting just from a yield standpoint. So investors whose financial plans really require current cash flow, I think there's very little incentive to go out further on the curve than sort of that 2 to 5 year range. Investors, though, who are much more comfortable maintaining a higher equity portfolio and still need some type of hedge potentially if the economy does start to unwind, will need some duration to benefit from lower rates, right? I think we all agree that the Fed would start to cut rates very aggressively if we were to enter a recession. And if rates go down, longer-term bonds produce more capital appreciation than do shorter-term bonds. And so the more equity-oriented investor still might find some attractive opportunities longer in the curve, maybe 10 years. I don't see much benefit going beyond 10 years. But I think for more clients who are sticking with their financial plans, being very diligent about the cash flow being generated from a portfolio, I think that 2 to 5 year part of the curve really looks pretty attractive still.
Yep. Yeah, you've hinted on the financial plan aspect here. It really does help with portfolio management in general, and then it gives us a North Star. It gives us something to work towards, and it can help make what might be a very difficult decision a little easier, in that we know what we need to achieve given the financial plan, to have that there in place as a target to work towards. So that's the Treasury curve. Let's now flip over to the municipal bond market. So we're looking here at a similar curve across, in this case, AA general obligation municipal bonds, and just the change in interest rates on the municipal bond side. So a lot of clients and investors who are interested in receiving more tax efficient income rather than just treasury bonds often turn to the municipal bond market. And here we're talking about AA as a rating in general. So very high quality municipal bonds in this case. But Neil, any differences here, what you see versus the Treasury curve over in Muniland?
Yeah, Tuck, I think here we have a little bit different message. I think, I think we'd all love to be investing in buying, AA rated munis above 5%, where the curve was in June. And though even rates now are down 75 or 80 basis points, if we're still looking at a 10-year AA muni at 4.41% yield, taxable equivalent in the 31% bracket, that's still a little over 6.5% return. That's going to work for a lot of cash flow models, right? For a lot of financial plans that need steady cash flow. I think the bond market, the municipal market, still looks a little bit more attractive, certainly for taxable clients, than does the Treasury market. And I think I'd be more inclined to probably go out to 7 or 10 years in the municipal market than I would be on the Treasury curve.
Yeah, makes sense. And, for those at home, the higher your tax bracket, then the higher the tax equivalent yield would be, in that you're able to retain more of the income that you earn and avoiding that higher tax rate that you might be in. So, some great points there. That wraps things up for the Q3 update. Q4 is already underway and already going to be an exciting quarter, no doubt. We have a lot going on, not to mention an election here in the United States. So a lot to talk about, but really thanks for joining us, Neil, and providing your insights.
Great. Thank you, Tuck.
Thanks for joining us. I've been Stephen Tuckwood, Director of Investments, joined by Neil Falconberry, Managing Director. If you have any questions, please feel free to reach out. If you like this video, please like, share, and subscribe.